everyone. Welcome back to the Midnight Markets podcast. My name is Sofia Cruz, your host, and here we break down trending financial topics with insights from the sharpest minds in the industry. This week, I'm being joined by Ojas Chitnis. Ojas, could you introduce yourself a little bit more to our audience?
For sure, Sophia, and thanks so much for having me. Thank you so much for putting this together for students here at GW. Like Sophia mentioned, my name's Ojas. I just graduated with a major in international business and finance. We'll be returning to Deutsche Bank in the sales and trading division come this summer. You know, here at GW, I've really benefited from the mentorship of people. I was originally, when I came into GW, I was very interested in politics, economic development, that sort of thing. Very early on, I realized that that was not a viable career path for me personally, but was immediately connected with the first iteration of the Finance 360 program, and that was super transformational for me. I got to hear about different markets and how different roles within high finance interacted with those markets, and I was immediately drawn to transactions and sales and trading, and eventually was able to land a full-time job. But along the way, I did some internships in wealth management, portfolio management, credit risk, corporate finance, a wide gamut of industries, and eventually was able to settle on sales and trading. I have been super fortunate to do an internship at Deutsche Bank and will be going back full time.
That's amazing. What exactly did you do at Deutsche Bank?
Yeah, so we had a rotational program. My first rotation was more on the banking side. I was doing like the creation of mortgage-backed securities, structured credit, that kind of thing. My second rotation was in derivatives, focused on corporate clients. And then my third rotation was in securitized products, sales and trading for ABS, CMBS, RMBS, and CLOs.
Nice. You mentioned structured credits. I want to get your take on what's currently going on. You've seen tech stocks dropping. Do you believe that this is just market correlation, or there is a bigger issue that we're not looking at, or we're not taking a deeper insight into? What are your thoughts?
Yeah, so I think that's a very interesting question. And like people say, like, if I knew the answer to that, I wouldn't be sitting here. I'd be a very successful day trader in my own account. But what I think is really important is to drill down kind of what is equity valuation. And I think this is where students kind of get tripped up a little bit. I think there's very much the tendency where people can like just look at a stock and like out of thin air pull out like, Apple should be worth this amount and Tesla should be worth this amount. But the underlying value of the stock is something that's much more easy to look at. So on the debt side, on the bond side, it's a little bit easier to grasp. What you're looking at is just, what is the value of the contractual obligation between the company, the government, whatever, and me, in 1 year's time or 2 years' time, whenever the bond matures. It's a very similar outlook for equities, except you don't really know what the numerator is. Mm-hmm. The numerator is the future earnings of the company, whether that be earning itself, the dividends, whatever. It's the money that could potentially be returned back to you as a shareholder. Because as we know, the shareholders are the residual claimants of the company. So if the company dissolved today or in 10 years, 25 years, each shareholder would get their slice of the pie. And the way we figure out how much a stock is worth is just by taking that and discounting it back at a rate which we use the cost of capital. So kind of when we talk about movements in the market, I think it's very good to decompose it into two things. Is it the numerator? Is it the earnings that are going to be coming down? And we'll talk about that in a little bit. I don't think that's where people are looking because that's really a single name equity thing. That's not a broad market trend. Or is it the denominator? Is it the cost of capital for a company, which as you'll probably know from your finance classes, is the capital asset pricing model. It's market risk, which is driven by inflation and interest rates. Risk premium, which again is company specific, so that's not something we're going to be seeing as a broad market trend. And that's really it. I think when we look at that, to drive a little bit deeper into that, the reason why I say it's probably not earnings, is because there's this concept of price to earnings ratio, which obviously is company specific, but you can take the price to earnings for the whole S&P 500. And there was a good researcher, Bob Schiller, out of Yale, I believe, actually a PhD student of Modigliani of the Modigliani-Miller theorem, but that's a side note. So he has the Schiller CAPE, cyclically adjusted price to earnings ratio, which takes the S&P 500's PDE, not over a single day, but it's over 10 years. And what we look at is that, yes, PDE for the broader market has increased substantially in the last 10 years, but it is still lower than it was at the time of the dot-com crash. And yes, it is true that high cyclically adjusted PE is associated with market crashes, but that's correlation, not causation.
Exactly. You mentioned bond market and also overreact, like different shifts that have been happening. Like, do you think bond markets are overreacting to what's actually been happening with Treasury yields and their relationship to Fed's meetings? What's your take on this? Because there's a lot of, whether it's uncertainty or people are just wondering if should we be worried even about this or should we just leave it behind?
Yeah, I think there's a great scene in The Wolf of Wall Street where Matthew McConaughey is talking to Leo DiCaprio, and he's like, no one really knows where the markets are going, least of all people that work in finance, right? And the application of that is there's a good chart that the Journal and a couple of other publications put out. It's, forward expectations on interest rates versus, what the Fed actually did. And if you go and look that up, and I encourage you to do so, you'll notice that the actual line of the Fed policy is very different from what people thought it was going to be, and also very different from what the Fed participants thought themselves the policy rate was going to be. And the reason I bring that up is that investors are often wrong about what they think the Fed is going to do. The Fed's goal is not, as many people think, to maximize the returns of the stock market. The Fed's goal is very simple, set out by Congress. It's dual mandate: control unemployment and control inflation. Everything else is secondary to those 2 points.
Wait, that's literally their point in the entire equation. But when you mention like different rates that have been really imposing their position, right? It could be like wages and unemployment. And these rates have been alarming to some people because like the job market's doing well, but prices are going up and wages are not covering that properly. So there's people who are worrying about a possible stagflation. What are your thoughts on that? Is there going to be a deeper issue or not?
Yeah, so I think what it comes back to is that at this moment, I think we're in a very interesting position. So the Fed meeting is tomorrow from when we're recording this episode. And I think the expectation 3 months ago was that the Fed was going to cut again, today or tomorrow.
Exactly.
And I think what we're seeing in options markets is that is not really where pricing is. And I think what's interesting is that I think this is the first time this has happened. The Fed was on an easing trajectory and the markets had priced in very substantial cuts, which were starting to get realized in August, September, November of 2024. But now we're at a pause. We're at an impasse. And I think a large driver of that is there's been a sharp uptick in volatility in the markets. One, due to increased uncertainty about what's happening in Washington and how that impacts businesses, but also we're seeing just across markets, there's been a lot of correction in prices and equities and other asset classes. So coming back to your point about stagflation, I think that, again, that's a view that you can take. I don't think any one of us has a crystal ball as to where the data is going to land. I think the Fed thus far has done a fairly good job of at least slowing the pace of inflation. We're not seeing rapid increases in the pace of inflation like we were before they started their cutting cycle, their hiking cycle. But I think it's also kind of frustrating for the Fed because the job market has been very resilient, but we're starting to see kind of weakening consumer resilience. And I think that's where it comes down to stagflation, right? That the largest driver of inflation obviously is wage inflation. What happens is that, prices are really high. So you go to your boss, you ask for more money, you end up spending more money. That causes an uptick in demand. So it's really a self-destructive cycle. But what that causes is that, in periods of stagflation, we have persistently high inflation, which causes the Fed to need to raise rates like they did in the 80s. Like they jacked rates up to like 16%, which is like hard for us to even wrap our head around. But the reason why I don't personally think that that's going to happen is because of the resilience of the American consumer. I think we've seen that people are still willing to spend even as this cycle has persisted. Americans are always going to need to buy homes. Americans are always going to need to finance cars, whether it's at 0 or 5%. I think the conventional wisdom is that like if you look at economics, like it should go down. But we saw over the past couple of years, people are still buying houses.
Yeah.
People are still buying new cars. People are still engaging in home improvement. I think the rate has decreased, but there has been activity there. I think another thing to note is that the U.S. economy is very unique. I think someone said this, that what happens in the U.S. has very real impacts on the rest of the world. Like someone sitting in Karachi, Pakistan, or Beijing, or anywhere else across the world really does feel the impact of what the Fed does. And I think what's unique about the U.S. is that doesn't really happen in reverse. Like I don't think an American consumer really gets affected by anything that happens outside of the Fed's purview. And the reason why that's important is that the Fed has complete control over what happens in the U.S. economy. And what they've become very good at is causing, recovery, economic recovery, to be at a very accelerated pace compared to what's possible in the rest of the world. We look at countries like Argentina, who have had this persistent high inflation for something like 90 years, whereas the Fed was able to curb inflation post-COVID fairly effectively. And think about like the Great Recession, the largest thing since the Great Depression, that was over in like 7 years. I really believe even if we were to enter a period of short stagflation, the Fed does have tools available to it, which although may be painful for the average consumer, would help us get out of a period of stagflation eventually.
Yes, and when markets are this volatile, shaky, call it whatever you like, based on your knowledge in portfolio management, you've told me before that you've worked on it. How do you go through these news and these really different trends that we've seen before?
Yeah, I think that a really important thing, obviously volatility is important to look at, but I think volatility is just a measure of what has happened. What assets are considered risky. I think this is kind of where the disjointness comes from, like a day trader and someone who's investing in their like retirement account or their kid's education account, whatever it may be. That we're not investing for tomorrow. So actually, potentially you might like volatility or you might not like volatility. It really is up to the profile of an investor, and that's really what portfolio management is all about. But coming down to your question, what do we look at as market participants? You look at volatility and you might want to maximize, minimize, whatever it may be in your portfolio. But generally, when we look at like managing a portfolio, your goal is what? Maximize returns, minimize volatility. And there's all sorts of complex math and whatever that helps you do that. But what it comes down to is you're trying to find assets that are, mispriced. You're trying to find places where there's good returns available for a lower amount of risk. And that's why we see in times of economic stress, people rotate out of equities and into fixed income. And then inversely, when the economy is doing really well, people rotate out of fixed income into equities. And I think another really important thing to look at is what I just mentioned, flows. One, where is money moving between accounts that already exist? Is it moving from equities into fixed income? Is it moving from single name equities into funds? Where is that flow happening? And also, where is the new money going? Because the savings rate tends to stay pretty much the same, across major developed economies, with the exception of like March 2020. But like, it tends to stay the same. So where is that new money going? Is it going into people's 401ks? Or is it going into, say, home improvement or, immediate spending? And I think that's what's really important to look at. And if you can look at that, you can take a view on where specific assets are going. So say that you have this view that people are going to be able to buy new homes or whatever. They're going to be deploying a lot of capital that they've shored up over the last couple of years. You can make a play in terms of, let me invest in industries that benefit from that. Residential solar.
Real
home
estate
building.
developers.
Exactly. Or if the inverse is true, that's maybe not going to happen. You may want to deploy your capital elsewhere. And kind of coming back to the beginning, what we were talking about, like, has this, correction in the tech equity market, does that have broader implications for the rest of, all asset classes? And I think you do have to take a view. Like, what is happening? Is it that people are starting to realize that the Nvidias, the Apples, the Microsofts of the world, is it that they don't deserve the valuations, the PE multiples that we've given them, or is it that the discount rate has changed? And I really prefer to think that it's the latter. That we're in a period of very high market uncertainty. People really don't know what's happening, and because of that, expectations of future inflation and future interest rates are much higher than they were, say, just 3 months ago. And as a student of finance, it's really, I think, an interesting time to be sitting, because now you're going to look back on this in 4 or 5 years and see, was my call correct that the Fed, had to immediately turn course and increase rates? Or was the Fed able to overcome maybe market volatility and continue on its easing cycle?
Well, that's really nice perspective. Thank you for sharing your knowledge because I mean we need to look at these certain factors and you talking about what we need to pay attention to. It's extremely crucial for us who are into not only markets but finance overall because these all relate to each other. So thank you for sharing your knowledge and being with us here today. And for our audience, thank you so much for watching till right now. Stay tuned in for next episode and I'll see you next time. Thank you.
The Midnight Markets podcast by the GWU Stock and Portfolio Management Club features student discussions on finance and market trends. This content is informational only, not professional advice.